The new trading week began with a discussion of the European Union possible embargo on Russian energy supplies. Since the opening of the weekly trading session, oil prices have continued to move down. A decline in the commodity value was provoked by the news about an extended lockdown in China. In addition, the quote is coming under pressure from expectations of a more aggressive rate hike by the Fed. Federal Reserve Chairman Jerome Powell said that an interest rate increase of a half percentage point would be on the table at the U.S. Central Bank's May meeting. At the same time, ongoing geopolitical risks associated with the events in Ukraine are keeping oil prices from falling more sharply. Now let's take a closer look at the trading chart. When the accumulation process came to an end, Brent crude oil futures gained a downside momentum. This indicates that market sentiment is mainly bearish. This, in turn, may lead to another approach to the psychological area of $99 and $100. Notably, the benchmark will see a trend change only after the price fixes below the 96 mark. Until then, trade is likely to be choppy. Expectations of an interest rate hike by the Fed is also putting downward pressure on gold prices. Last week, the precious metal edged lower and overcame a number of important levels. As a result, the asset lost 4% in value. If sellers manage to drag the price further down and break below the support area of $1,910 and $1,915, the metal will most likely rush towards the level of $1,890. Meanwhile, the Russian ruble continues to gain value despite its overbought status and the need for a correction. This is due to strict capital controls introduced by the Bank of Russia. The Russian regulator is closely monitoring foreign exchange transactions, thereby keeping the ruble from collapsing amid rising inflation and economic recession caused by the sanctions. The authorities have obliged export-focused companies to convert 80% of their FX revenue into rubles at rates denominated in the internal market by the Moscow exchange, while foreign investors cannot exit their Russian stock positions at the MOEX. Also, the key interest rate at the Bank of Russia is 17%, 750 basis points higher than pre-invasion levels. From a technical point of view, the dollar-ruble pair almost approached the local low posted on April 8. As before, the ruble's overbought status indicates the likelihood of a partial recovery in the value of the US dollar. At least the technical analysis suggests that the pair's imminent advance. However, if the price fixes below the level of 71 rubles per dollar on the 4-hour chart, its downtrend is expected to continue. And that's all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you soon.